Hello there, Maverick traders. This is Rob Reinhold. It's nice to see you here. This is Currency 101, and in this session, we are going to be going over bond yield correlations. All right, before we get started, just jump into the correlations. We need to cover what is a bond. What exactly is a bond? Now, a bond is debt. Now, you're going to be most familiar with government bonds, but corporations can also issue bonds. And they basically say, we want money now and we'll pay you back later. That is just what a bond is. And so you give money to a government or to a corporation, and there's always a term of the bond. So each bond is going to have a period of time where the bond is active. And then at the end of that term, or what's called duration, the government or the corporation has to pay you all of your money back that you lent it. And every bond will also have a yield. Basically, the interest rate that this government or corporation is going to pay you, because again, you are lending them money. They're saying, hey, we want more money now, we'll pay you back later. You're going to get an interest rate for that. All bonds are issued at a price of $100. Okay, now that is set. $100, every single bond starts out priced at $100. However, the interest rate that it starts out is going to be based on a few things. Number one, it's going to be based on what is the current interest rate around the world? What is the current interest rate in that specific country? Number two, how much risk does this bond have of potentially not being paid back? The quality of the issuer is a huge deal here, and bonds that have more risk or that investors think are more risky, they need to pay a much higher interest rate and able to convince investors to actually put their money. If it's a very, very safe investment, like a big central bank government, those interest rates are usually lower because of the risk. And so you've got the duration and you've got the interest rate. So let's just take a look at this one right here. Let's say this is the US 10-year government bond, and it starts out at 3.4% interest. That is the issue price. That is the issue interest rate. If you went in and bought $10,000 worth of this bond, your interest rate is fixed. It will never change. You will make $3.40 or $340 every single year off of this bond, guaranteed, unless they default. That is your fixed interest rate. Now, that bond is very simple. Everyone understands, okay, that's how a bond works. We can move on. Well, not really, because these bonds are assets. They can be bought and sold all the time. So you could buy the bond, this 10-year bond, and after a year, you might decide, you know what, I want to sell this. I want to sell this. Here's the problem. You can't sell it for $100. You won't be able to sell it for $100. That was the starting price. The value of this bond is going to be adjusted based on what happened with interest rates. So whenever we talk about bond prices and interest rates, we need to understand that it's a teeter-totter. If the value of the bond is low, the interest rate is high. If the interest rate is low, the value of the bond is high. So let's take this interest rate. So let's take this scenario. So right now, this bond has an interest rate of 3.4%, and the value of the bond is 100. If this interest rate goes down, then what happens is the interest rate declines, and then the value of this bond goes up. Now let's talk about why. Remember, this bond has a 3.4% coupon rate, is what it's called. Let's say that interest rates drop all the way down to 2%, where anyone buying a new bond right now is only getting 2%. Well, all of a sudden, they're looking at your bond that's getting 3.4% saying, hey, I'm willing to pay more for that one. So what happens is the value of the bond goes higher if interest rates go lower. Now, let's say the other way happened. Let's say the interest rate shot up to 6%. All of a sudden, your bond with a 3.4% interest rate does not look as good. So whenever we talk about price and interest rate, it's always inversely correlated with bonds. Now, the reason this is so important is because in the currency market, there is currency swap rates. Now, if this is new to you, please go and watch our currency swap rate video that will walk you through everything, but I'm going to go through it very quickly here. You get paid, or you have to pay, to hold certain currency crosses. So an interest rate swap is simply the swap where it involves two parties, and they exchange equivalent amounts of two different currencies, and each party must pay the other party the amount of risk-free income that they could have generated if they just left it in the bank. So let's go through an example of this here. So let's say that we are looking at the Aussie dollar Japanese yen currency cross. And let's say that we took a position that we are long $100,000 worth of that. Now let's think about exactly what happened. We are in the US, but we wanted to buy the Aussie yen. Now what that means is that you have bought the Aussie and you have sold short the yen. Now if you have sold something short, you have borrowed it. You had to borrow that. And so you owe yen back. You own Aussie dollars and you owe yen back. So theoretically, you borrowed 100,000 yen and you bought 100,000 Aussie dollar. Now remember, whoever you get that money from, you have to pay because they are no longer receiving an interest-free rate of return. However, you are now investing it in Australia, and that currency is going to earn a cash interest rate payment. So as you can see here, with the central bank rates, the Aussie is paying 4.25, the yen, which you have to pay out negative 0.1. All of a sudden you can see that the swap is 4.15. Now look, you are never going to get 4.15 because it is plus costs. The broker you use, they're going to add in all their fees into it. So it might be somewhere like 3.9%. If you're curious, you can always go onto their website and see their swap rates. They publish them on a regular basis. Let's say that we are in the opposite cross. Let's say that we are short 100,000 Aussie yen. So remember, we borrowed 100,000 Aussie yen and turned around and bought 100,000 Japanese yen. So what that means is that whoever we borrowed it from, we have to pay them 4.25%. Because again, we borrowed the money from them. They can no longer earn a risk-free rate on that money. And now we've bought yen that hardly pays out anything. So as you can see here, we have a negative currency swap. Now 4.15 plus cost, this might be negative 4.4. That might be what the swap rate is published. So I really need you to understand this concept because this is why we care so much about central banks and interest rates. Because as central banks, they're the ones that really move a country's interest rate to where all the banks follow them and interest rates rise and fall on what they say. The swap rates are always changing based on these interest rates. And if the swap rate improves, your currency becomes more desirable. People are going to want to buy it more. And if the currency swap declines, all of a sudden, your currency pair is no longer as valuable. So let's look in and take a look at the actual charts of correlation between the price of currencies and their underlying bond yields. Let's take a look first at the dollar basket. So I'm going to come up and find my dollar basket, which is this right here. And let's look at it over a daily chart for right now. Now, what we're going to want to do is we're going to want to compare the dollar to its bond. Now, there are different durations of bonds. There is a 1-year bond. There's a 3-month bond. There's a 6-month bond. There's a 2-year bond. There's a 3-year bond. There's a 5-year bond. There's a 10-year bond. There's a 20 and a 30-year bond. They're even talking about issuing a 50-year bond at some point. Look, you need to pick one of those as your standard. I'm going to recommend that you choose the 10-year. The reason why I'm going to recommend that is that all countries have different durations. And some countries don't offer a 2-year bond. So if you say, hey, I want to look at a 2-year bond or a 3-year bond, and then you want to take a look at the Swiss franc, you're going to find out that the Swiss do not issue bonds of that duration. Everybody issues 10-year bonds. So I'm going to be looking at using the 10-year US government bond. Now, to compare anything on TradingView, you simply come up here to this plus symbol. I'm going to hit that. And I'm going to put in, again, US 10. Now look, this is going to take you a little bit of time to find symbols. If you need to find symbols, go just into the search, play around with some combinations. But you can see here, I just found this US 10-year government bond. Now in TradingView, if you don't click this correct button next, you're going to get a chart that's fairly unusable because one of these is going to be way more volatile than the other. So you're going to get the interest rates are way more volatile on a percentage basis. They move 4, 5, 6, 7%, where a currency moves 0.5% a day. All of a sudden, you're going to see that the price of the currency is tiny and the price movement of the yield is huge. So you need to come over and choose this new price scale button. What this is going to do, it's going to say, hey, we're going to set these on different price scales and add it in a panel over here. So I've got this panel over here, and then I've got the price here of the basket. Now we had some big movements here. This is off the FOMC meeting. But if we go back and see, okay, as we see interest rates move, you can see that there is a little bit of a correlation. In this example, you can see that the currency is actually leading. It's actually leading the interest rate. You can see here, it started to fall here, the currency did, and the bond yields topped out, a couple days later and started to decline. We had a big bounce in the currency. Now we're seeing the bond yields follow. Now look, sometimes they lead, sometimes they follow. You can't really know exactly what it's going to be. So this is why we just simply have to look at some charts. Again, I want to find, where are there some correlations? Now remember, with correlations, things aren't always correlated. And if they're not correlated, you have to wait for them to be correlated. You have to wait for them to actually matter. So I'm just going to go back in history here. I'm going to go stretch this all the way back here, and we're just going to take a moment in time. Okay, so here is the US basket, and you can see we had a big fall in yields. Big fall in yields. The whole time, the dollar was actually fairly stable. However, if we go forward here, we can see the dollar starts to weaken off this. And as these go lower, these start to weaken a little bit more. Then we get the turn up higher. As you can see, we get a turn higher. Let's see if that price of the currency follows. We can see this is one of those times where it's just not correlated. It's just not correlated, not following it. As it starts to decline, you can see the correlation now coming back into play. And as the currency falls, the bond yields fall with it. Now we're starting to get some stabilization of bond yields. Let's see if the currency follows at this time. You can see the currency is flat to starting to strengthen here. So in this example, you can see that interest rates are actually leading the currency. And as the interest rates continue to run higher, the currency continues to appreciate and really does quite well. We just had a run from 108 up to 110. That's a 2% run in a currency over just a matter of a week or two. Let's follow this correlation. Now we start to see the bond yields are now starting to make a lower low. Let's see if the currency follows in suit. You can see the currency is doing its own thing. It doesn't really want to pay attention. All right, now the one last thing I wanted to show you how to do is to make a relative strength chart based on yields. So if the premise is that bond yields are correlated to currency values, wouldn't it be nice to be able to take a look at all of the bond yields of all the countries over a set period of time and say, hey, this one has actually been the strongest, and then go out and find that currency of the one that's been the strongest and pair that against the one that's been the weakest? Yeah, absolutely. So I'm going to start out here with the dollar basket. And what I want to do is I want to use this add or compare symbol. And all I'm going to do is load in all the other 10-year bond yields. So first off, let's take a look at the euro. and we want to choose the Euro 10-year government bonds yield. Now we can just choose this because it's priced in the same amount as dollars, so we can just simply click this and get this chart here. Next, I'm going to add the UK, so I'm going to go GB 10, looking for the GB 10-year yield. I want to load in all the yields here. So I've got that one in. Next up, let's take a look at Canada. I want to take a look at the 10-year Canadian government bond yield. Add that one. Let's add in Switzerland, CH, 10-year bond yield. We're going to add in Australia, 10-year government bond yield. I'm going to do New Zealand, 10-year government bond yield. And lastly, let's add in the Japanese 10-year government bond yield. All right, so now we have this in, and we can say, okay, where's the biggest move been? And I also, let's put in, sorry, I'd add the US currency basket. I want the US 10-year government bond yield, which is right here. So now I have everything. And so the question is, okay, let's take over the past month. Over the past month, what currency has had the biggest rise in bond yields? And you can see that before this big spike here by the yen had a huge spike here. Before that, Swiss franc had a really nice rising currency yield. The second strongest one was the euro. So these are the two fastest moving currencies to the upside. Let's just go ahead and take a look at those. Let's take a look and see how those currencies did. Swiss franc has been a pretty good performer as of late. You can see a big jump higher here. We did have a central bank announcement here, so we saw a big move up in Swiss franc. The second strongest was the euro. Let's take a look at how the euro performed. And you can see that the euro has been going up a little bit, but lately it had been going lower. But let's take a look at bond yields. Their bond yields took a little bit of a dip. Let's check out this yen. Let's see what happened on this big spike in yen yields. Let's see if that translated over to a big spike in the currency itself. And you can see we got a very nice spike here in the yen here to where it moved up, most likely because of the yields. I'm not going to go through any other ones here because at this point I just wanted to show you how to do this to where you can go and recreate this. If you like, you can build these charts to where you always have the 10-year bond yield on your chart you're looking at. So here is the yen. You could actually save this to where you always have the bond yield overlaid next to it. And I did it wrong. I needed to add it on a different price scale. You'll get used to that. New price scale. Now you can see that you've got this along with it. Only trade this when the correlations are there. When the correlations aren't there, just go ahead and discount it. But right here, right now, is telling us that bond yields in Japan are significantly higher, and the currency is most likely going to follow that. So let's wrap this up. I want you to understand what the swap rates are. If you don't understand it, go watch our swap rate video. Next, if you understand how swap rates work, then all of a sudden you understand what a big deal interest rate changes are to currency values. The currency swap rates, and the larger these swap rates get, the more important they are. I started trading Forex back in 2007. I've been trading stock and options since 1999. And in 2007, there was a phenomenon going on called the carry trade. And the Japanese yen interest rate was at about 0.5%. And New Zealand and Australia, their interest rates were at 10, 11, 12%. And so just from holding on to the currency for a day, you would get paid maybe a couple $100. So there's a lot of people playing in this space, and it just made the trade get even bigger. So the more and more people that were buying Aussie yen, it caused Aussie yen to go higher and higher and higher and higher. Then what happened was the financial meltdown happened, and there was a huge collapse. And basically all the air that was in there, all the speculators, they got out, they got wiped out. And we saw that currency cross drop over 50% in a couple of months. That is just a huge move in currencies. So once you understand how it works, all of a sudden now you can start to add in another little layer to your trading, to where now you can actually pay attention to bond yields, see what they're doing. And as I showed you, build that relative strength chart so you know which yield currently is the strongest and which one is the weakest. That's just going to tell you what to hunt. It's not going to tell you when to get in. It's not going to tell you where to put your stop. It's not going to tell you whether you should pyramid or not. It's not going to tell you any of that. It's only to help you hunt for something where you say, hey, you know what? Right now, the Swiss franc, their bond yields are going up the most. Let me see if the chart supports a buying of the Swiss franc, and let me go into the charts and pick my entry points. And then what am I going to pair it against? Okay, these have been the weakest bond yields. Let me take a look at these first. It's just a way to help you understand what to trade. Thanks for joining me, everyone. Goodbye.